Imagine buying a business for twice what it's actually worth on paper. Sounds crazy, right? That's what several investors do when they don't check the PB ratio. So today I'll be breaking down a key number that helps smart investors decide which stocks to buy, the price to book ratio. Welcome to Finance Now, where we make finance easy for you. The price to book ratio or PB ratio simply means how much are you paying for a company compared to what it actually owns. Let me explain. Every company has assets, buildings, equipment, cash and investments. When you subtract what the company owes to others, you get what's called the book value. It is the company's net worth on paper. The PB ratio tells you how the stock market price compares to this book value. For example, if a company has a book value of 100 rupees per share, but its shares are selling for rupees 200 each in the market, going by the formula for the PB ratio, market price per share divided by book value per share, the PB ratio for this company is 2. This means investors are willing to pay double what the company is worth on paper. So why does this matter? Because the PB ratio helps you understand if you are getting a good deal or not. When a company has a high PB ratio, let's say 5 or above, you are paying 5 times what the company's assets are worth. This might indicate that investors are optimistic and expect growth. It can also indicate that the stock is overvalued and maybe it's time to book your profits or sell. On the other hand, a company with a PB ratio below 1 means you can buy its shares for less than the value of its assets. For instance, if the PB ratio is 0.7, you are essentially buying 100 rupees worth of assets for just 70 rupees. This might seem like a bargain, but it could also be a warning that investors expect the company's value to drop further. A low PB ratio can also be a warning sign indicating that the company might be facing multiple challenges like poor earnings, high debt, or other fundamental issues. So what is a good PB ratio for your investments? Well, different industries typically have different PB ratios. In India's stock market, a stock with a PB ratio of less than 1 is generally considered as an undervalued stock, while a stock with PB ratio less than 3 is considered a favorable one. One important thing to remember, a low PB ratio isn't automatically a good deal and a high one isn't necessarily bad. You need to compare companies within the same industry and consider their growth prospects. The point is, a PB ratio is not a sole indicator of how a stock will perform. This is just one tool in your investment toolkit. Use it to spot potential opportunities, but always dig deeper. Use other metrics before making investment decisions.